Hello, everyone. This is Mark Lair, and we're back for another in our series on the Infrastructure Channel, learning all things about infrastructure in this year of change and leading into a decade that will be very important for all infrastructure projects. And I'm thrilled to have with us Andrew Charlesworth from CAMG LLP, which really is an infrastructure fund, focuses on raising the money, public and private, for these projects that help get the project underway, but have returns that go back to shareholders for both long-term growth as well as income. So Andrew, welcome, and if you could give us a little bit of background on your story, and then we'll get started with questions that help this channel.
Great, thank you, Mark. So my background is I'm an engineer, so it's really moving from that long-term delivery and engineering of infrastructure that I've got involved in project finance about 20 something years ago. We, as a team, we pulled together around 16 professionals, and it's really about the experience and expertise in bringing the finance and capital into the projects to deliver long-term sustainable projects at a local level. So they're actually delivering sort of value for the communities as well as for the investors.
Now, this is not really public funds, but they're more private funds. So talk to me about the types of different entities that would be investing in the projects that you're working on that are not public.
Yeah, absolutely right. My background up until recently, I ran one of the largest listed infrastructure funds. So, there are public funds, if you like, but we're focused on the private fund market. So typical investors are pension funds, insurance companies, institutional investors. And what's great about that piece is that really it kind of creates the circular economy. So you're putting individual pension money, people's individual pensions through their funds into these long-term assets. And it's really about that sort of match of the outcome for you as a pensioner, looking for long-term inflation-linked returns that fit so well with these infrastructure assets, because ultimately they don't correlate typically they don't correlate to the listed markets, to equities, to bonds. They have this sort of long outlook, steady, stable revenue that has inflation linkage. And of course, as we're moving forward into a sort of post-COVID world, so inflation's beginning to rear its head again. I think many of us have forgotten what the environment was like 15, 20 years ago with inflation. So that's the great thing, is that you're creating a sort of circular return where pension money is used to improve or provide new infrastructure, which ultimately generates that economic stability and growth in the country, which delivers the value for the pension holders in the longer term as well.
Obviously, these are very long-lived, and so how do you? Is there a unique structure or a special structure that provides for not only the capital growth but the long-term income, just so people can see the near-term benefits of the project getting underway, but really the long tail as the project matures?
Yeah, so typically on a new build infrastructure project, the financing requirement is obviously for the construction and development of the project. And typically you use a high degree of debt lending from banks, but because they need the equity to come in from private sources. So it's by structuring the projects in this way, you bring in maybe 20, 30, 40% equity funding into a project. You borrow the rest as long-term debt or even bonds in some cases. You're then financing the construction phase. And that might be anything from, in the shortest term, 1 year, up to the longest projects, the very large macro infrastructure projects, if you like, could be 5-6 year construction period. So there's limited yield during that period, but really then you're into the space of delivering these 20, 30, 40, 50 years. Some of these projects are expected to last for 60, 70, 80 years. So you're then talking about this long-term annuity revenue coming into the project. One of the things that is a particular feature that's actually exciting and interesting and slightly different in the US is that there's a huge backlog of maintenance and improvements that need to be done. So interestingly, we tend to use the phrase primary brownfield. So brownfield is an existing project that's running. The primary brownfield project is, from the phrase that we use, is a project that's already operational, but it needs improvement. So actually you could be structuring a project which is generating those returns right at the outset. There's a big capital investment required to improve it, and those cash flows could then increase. So you could be talking about a sort of relatively low yield in the early years, but building up to a much higher yield in the longer term. So from an investment perspective, the investors ultimately are investing in a project which is growing in capital value, typically over the first of 3 to 5 years, but then converts into this annuity, steady stage, sort of yielding type investment.
I would imagine that the investors appreciate a portfolio effect of these projects. Do they look for geographic distribution or different types of industries? How do they think about 5, 6, 8 projects that they'd like in a portfolio of this type?
So that will depend very much on the investor. So yes, absolutely, investors like a portfolio approach and they like to spread the risk, as is well understood. Some investors would like to have a discrete fund that focuses on one sector, whether that might be renewable energy or oil and gas or transport. Other investors tend to focus on a strategy, whether it's more primary and less operational. Many funds are raised to acquire existing projects. A lot of the infrastructure funds are also focused on sort of private equity in infrastructure, if you like. So they buy a business, whether that's a water company, an airport company, whereas others, and this is where we fit, tend to focus very much on the assets themselves, so the individual projects. And what we're looking to do is to deliver investors that spread across what we think of as the lower mid-market, so more into the sort of social infrastructure space, whether that's transport or utilities. So we cover a lot of those individual sectors, and key to us is the actual investment risk. How these projects are structured, how secure their revenues are, how long it is a period of lack of yield. That's our focus. It's sort of providing that portfolio to investors through the sort of risk type of projects that they're looking at, and those projects where actually we can have the biggest impact in the sort of ESG, in the communities and environments in which we're delivering them, because that's the space where if you get the perfect blend of a project, you're delivering long-term sustainable value to investors, secured by sustainability and long-term outlook of the project. And if you build the ESG into the heart of the project, guess what? You're actually creating, it's just good business sense, you're creating a long-term sustainable revenue stream.
So Capital and Asset Management Group, should I think of that more as an advisor, thought leader, but also has a fund that invests side by side? Where do I have that right or wrong?
Yeah, no, pretty much right in all of that. I mean, the team came together largely. We all worked on the JLIF, the European Listed Infrastructure Fund that we ran. That ultimately, when we sat down, that was about a $2 billion fund, listed fund. So the team all came together there. We bring the experience across the whole spectrum of international infrastructure. We've delivered it as a team over $60 billion worth of infrastructure mandates. So we are the investment advisor to the fund. So we're providing that expertise and really picking up then on what's the added value to investors. Typically the investors in these projects, most of them don't have the bandwidth to have the expertise required to diligence, review, appraise these projects, but then most importantly from our point of view, to then actively manage them through their life. So when we're investing in a project on behalf of investors, we bring that proactive asset management, that over 200, 300 years of experience of actually delivering these projects on the ground. And that's really, again, what's key to sort of delivering the sustainability. So you're absolutely right. We are the sort of the expertise and experience in knowing what we're looking for, knowing how to structure it, knowing how to manage it, and how to really deliver it on the ground over that sort of 20, 30, 40 years to provide that value.
I see a really interesting parallel. Open Exchange is a video conferencing solutions company helping people do complicated meetings. And we had the infrastructure in place to do a lot of meetings. And then when pandemic hit, we had to scale up massively. You're at the cusp here of the infrastructure bill. You've got the infrastructure right now to help companies, advise them. But you talked about bandwidth. If this gets passed and you have hundreds of projects all of a sudden coming to the fore next year, what's the bandwidth going to be like for firms like yours to advise and help people through that process?
Yeah, so I think the infrastructure bill, it's fascinating in many ways, and you're right. It very clearly states that there's a significant need for improvement of existing and delivery of new infrastructure, and almost an infrastructure revolution in what we think of as infrastructure. So in the olden days, we think of infrastructure as railways, roads, and airports. And today, especially with this bill, there's a realization that infrastructure is about the internet. It's the Internet of Things. It's hydrogen transport. Right. It's about electrification. It's about technology and delivering infrastructure. The thing that's really key for us, though, is that, as you said, we focus on, we tend to think of it as public-private infrastructure rather than private-public infrastructure, if you like. So this is public infrastructure, which is developed for the use of the community, for the public, but it needs private capital to come in order to deliver the outcomes. And that's where this bill is fascinating, because it starts talking about forecourts, fuel provision, plaza stations. It talks about nurseries, nursery provision. It talks about the internet and broadband. So all of those is infrastructure, which is essentially there is private provision of it, but it's publicly sponsored, if you like. And that's where this bill is so interesting, because if you look at the requirements for the backlog of infrastructure maintenance and spend, the American Society of Civil Engineers is predicting the need for sort of $4.6 trillion. And of course, the bill only fits a very small part of that. So it's leveraging that private capital into it. So the bandwidth, as you say, it's going to increase. But the thing that's really exciting for us is it's increasing in exactly that space that we have experience in and love, which is that sort of community-based enabling infrastructure, those that matter to the people sort of on a day-to-day basis. And that's where we see the sort of the big bandwidth growth. Now, those projects have been around for a long time. Water, no one thinks about water when they turn on the tap, but ultimately the infrastructure required to deliver clean drinking water, that's what we deliver. That's what we look to provide. So that's the exciting thing for us is this growth in bandwidth, this growth in opportunity, and really bridging that gap between the appetite for investors who are happy to, willing to, and want to finance these projects because it delivers that long-term value to their custodians, to the pensioners or to the insurance partners, with the sort of public outcomes of the projects. And again, it comes back to that for us, this great synergy of meeting sustainable long-term projects that have inbuilt value to them are ultimately actually what the investors want as well. So you're in a quid pro quo, you're in a sort of double gain by actually delivering that sort of ESG community outcome at the heart of the projects, because it comes back to, as I said before, good business sense. It delivers value to the investors by providing outcomes to the users.
That is just a great introduction to the Capital and Asset Management Group ahead of the 13th annual CGLA Infrastructure Conference that'll be in Washington, D.C. in a few weeks' time. I hope people get a chance to watch this on the Infrastructure Channel. And Andrew, I know you're not coming over for the conference because of the procedures, but perhaps we can do some interviews live as we watch the events unfold on that and carry this conversation forward.
That'll be great. And I'm certainly joining virtually, if not physically, but very nice to speak to you. Thank you, Mark.
Great to have you on today. Thank you very much.
Cheers.